All right, welcome back. So let's just jump right in, because today we're talking about a financial strategy you've probably seen popping up everywhere online, velocity banking. Now, the big question is this some secret hack to pay off your house in just a few years, or is it, just too good to be true? We're going to dig in and find out.
This quote from one of our sources, it just hits home, right? My average client now makes $10,000 a month, and they're broke. I mean, think about that. You could be making really good money, more than you ever have before, but it feels like you're just treading water, paycheck to paycheck, with that mountain of debt not getting any smaller. It's an incredibly frustrating spot to be in, and that is exactly the problem velocity banking says it can fix.
Okay, but before we can even talk about the solution, we've got to get our heads around the problem. Really understand it. We need to look at how a typical loan, especially a mortgage, is put together. Because the system is kind of set up with all the interest packed right at the beginning, and it creates this slow-motion debt trap that feels almost impossible to escape.
And here it is, the stark reality. Just look at these numbers from a real example in our source material. Your first mortgage payment, right? It's almost $1,000, but less than $100 of that actually chips away at what you owe on the house. The other $871, poof, it's pure interest straight into the bank's pocket. You're basically renting your own money for a huge, huge fee. It's wild when you see it laid out like that.
It can totally feel like the game is rigged against you, right? But what if there was a way to flip that whole thing on its head? A way to actually make your money work for you, instead of just padding the bank's profits? Well, this is exactly where the idea of velocity banking comes in. It's presented as a totally different path forward.
So what is this thing, really? Well, at its heart, velocity banking is all about using a line of credit. Think something like a home equity line of credit, a HELOC, as your main financial hub. It's kind of like swapping out your checking and savings accounts for this one powerful tool. And the goals are super clear. Pay off your debts way faster and, in the process, cut down the mountain of interest you would have paid otherwise.
Okay, that sounds great in theory, but how does this actually work? Like, what do you do day to day? Because it's not some magic button you press. It's a completely different way of managing your money, your entire cash flow. So let's break down the actual steps.
It really boils down to 4 main steps. First, you get yourself a line of credit. Then, you use a big chunk of that to make a lump sum payment on your main loan, like your mortgage. Now here's the big change. Step 3, your entire paycheck gets deposited directly into that line of credit, not your checking account. And finally, step 4, you pay all your bills, your groceries, your utilities, everything out of that same line of credit.
So why on earth does this work? What's the secret sauce? It's all about something called the average daily balance. See, with a mortgage, you're paying interest on this massive number that barely moves, but a line of credit is calculated differently. When you dump your whole paycheck in there on day 1, you crush the balance way down. Then, as you pay your bills throughout the month, it slowly creeps back up. But your average balance for the whole month is way, way lower. And that's the number the bank uses to figure out your interest. You're basically giving the interest a much smaller target to hit.
Okay, so if you do all this, and you do it right, what's the payoff? Well, according to the people who champion this strategy, the results are, honestly, they're pretty mind-blowing. We're not talking about shaving off a few months here and there. We're talking about chopping decades off your biggest loans. Just look at this chart. It says it all. That same 30-year mortgage we were talking about before, well, using this method, and this is the crazy part, with no side hustles, no second job, the source material claims you could pay it off in just 6.5 years. 6.5. That's wiping out nearly 24 years of mortgage payments. The time you save is amazing, for sure. But the money you save, it's just staggering. In that same example, you'd save over $176,000 in interest. Let that sink in. You save more in interest than the entire original loan was for. That's money that stays with you, building your wealth, instead of just vanishing into the system.
Okay, hold on. This all sounds incredible, right? Maybe a little too incredible. And that's when you have to pump the brakes and ask the most important question of all. Is this thing foolproof? What's the catch? Because there's always a catch.
Right, because the truth is, this is absolutely not a strategy for everyone. There are some really big risks and, frankly, some practical problems that can make this whole thing fall apart for a lot of people. So let's get real and talk about the downsides.
This one question, which comes from our Ascend source, might just be the deal breaker. Think about your own budget for a second. What percentage of your bills can't you pay with a credit card or a line of credit? The whole strategy hinges on running your life through this one account. But can you pay your mortgage that way? Your car payment? Your rent? For most of us, the answer's a hard no. And if your biggest expenses can't go through the system, the whole engine just stalls out. It becomes way less powerful, maybe even useless.
And yeah, the risks definitely don't stop there. First off, you need ironclad financial discipline. No exceptions. You're basically living off a giant credit card, and one mistake, 1 month of overspending, could be a total disaster. Then there's the fact that these lines of credit usually have variable interest rates. That means your payments could suddenly shoot up. And here's the big one. If you're using a HELOC, your house is the collateral. You mess up, you can't make the payments, you could literally lose your home. Plus, you gotta ask, is paying off a cheap mortgage even the smartest move when you could potentially earn more by investing that money instead?
So you've got this amazing potential payoff on one side and these really serious risks on the other. Where does that leave us? Well, it kind of forces you to stop thinking about personal finance as just a list of rules to follow and start seeing it for what it is, a game of strategy.
And I absolutely love this quote from the Fantastic Channel. It says, "We're playing a chess game in our finances, and we think that the game's set up and we have to play it their way." It's so true, isn't it? So many of us are just moving the pieces on the board the way we're told to. The whole 30-year mortgage, make the minimum payment. That's the bank's game, their strategy. Something like velocity banking is basically an attempt to flip the board and play by your own rules.
And really, that's what this all comes down to. Look, velocity banking might not be the right strategy for you, and for a lot of people it won't be. But just understanding how it works, understanding this idea that you can strategically use your cash flow to fight back against interest, that's incredibly powerful. It makes you step back and ask yourself a really important question. Are you just playing the bank's game, or are you playing your own?